Good afternoon, everybody, and you're very welcome to the Employment and Recruitment Federation webinar on the My Future Fund, all matters pension auto-enrolment. This is part of the Lunchtime Live series that the ERF has been running for some time. We're just going to give it a few seconds, just as conscious that, look, a lot of people are joining. So just before we get into the formalities, we're just going to pause for a few seconds and just give people the opportunity to join. We're scheduled for the next hour, and we're hoping to take you through a bit of a whirlwind tour of all matters to do with pensions auto-enrolment. Okay, as I say, you're all very welcome to today's session, and this has been organised by Jared King and Anna Douglas and the team in ERF. For those of you who don't know me, first of all, just a brief introduction. My name is Brendan McGinty. I'm managing partner with Stratis Consulting, and I'm the chief policy advisor to the ERF on employment policy matters. We're joined today, delighted to be joined by Paul Orde. Paul is the Assistant Principal Head of Auto-Enrolment Communications in the AE Program Management Office, and his colleagues Anthony Doyle and Lisa Arnold from the Department of Social Protection. Now, I think everybody at this stage is well aware of the pending implementation of auto-enrolment. This is probably, and Paul will speak to this no doubt, is probably one of the biggest policy implementation challenges, certainly in a workplace context, that I can remember that the state has sponsored. And this has been probably in gestation, even in my memory, it's probably going back at least 10 years potentially. And at long last, it is now pending from the 1st of January. Obviously, as colleagues will be aware, with every time you turn on the radio at the moment or TV, you're getting the opportunity to tune in to the government's major national awareness campaign that's been running really since July. We're expecting instructions probably being issued in early December in advance of pension auto-enrolment commencing in January 26th in terms of payroll instructions. And I think at this stage we're probably it's probably around an additional 750,000 workers that this will ultimately impact, and who will then from the 1st of January have access to this state sponsored scheme. That'll essentially, those 750,000 are people who are not currently part of a workplace occupational scheme or have private pension arrangements of one form or another. So look, to help us understand the journey towards auto-enrolment, what it means, its implications, some of the implementation challenges, which I know everybody is working through and hopefully working with their advisors on. We're delighted, as I say, to be joined by Paul, Lisa, and Anthony, just to help us understand some of the practical issues. And I'm sure, and certainly I know Paul will also take the opportunity to debunk some myths that are out there about what this is and what it isn't. So our structure today is Paul will speak to that agenda. We will pick up on some kind of key issues that I think everybody needs to be considering after Paul finishes. We'll have time for some Q&A at the end. We're also conscious that we've already received pretty much inundated with questions from participants and ERF members. We're proposing after today that we will finalize an FAQ following the webinar, and we will make that available through the ERF office. And hopefully between a combination of both that and today's presentation will help to address at least some of the practical issues that are foremost in people's minds. So really, I suppose, without further ado, Paul, I might just ask you I'll stop sharing and I'll ask you maybe to crack on with your presentation, and we'll pick it up from there.
Yeah. So hopefully everyone can see that.
Great, yeah.
So, my name's Paul, and I'm just going to give you an overview of my future fund, including the eligibility, contribution rates, and how the scheme's going to work. So, employees who are eligible for automatic enrollment will meet these three criteria. First is their age between, or the first is that they earn €20,000 or more across all employments per year. The second is that they're aged between 23 and 60, and the third is they're not already contributing to a pension scheme through payroll. So employees who earn less than 20,000 or who are aged between 18 but under 66 can opt into my future fund. And they'll be able to do this using an online employee portal. All employees whose pay is reported to revenue in the Republic of Ireland are potentially eligible for my future fund. So factors like contract type and length aren't taken into consideration. This means seasonal workers, part-time workers, workers on probation, etc. will all be considered for the eligibility test, and they'll also be able to opt in. People who are self-employed or not currently working and earning won't be eligible for my future fund, however, and they won't be able to opt in either. So we get a lot of questions. We get a lot of questions about how auto-enrollments will work for an employee who has multiple employments. So sometimes we just think that an example works better than a long-winded explanation. So let you look at this table here, and in this example, the employee has two employments. In job A, they have a gross pay of €10,000, and in job B, they have a gross pay of €15,000. So although they earn less than €20,000 in both of these jobs individually, their aggregated pay of €25,000 is taken into consideration for the income threshold. Therefore, they're eligible to be auto-enrolled. The employee will pay contributions for both employments, and each employer will pay contributions as a percentage of their gross pay that they pay the employee. And as you'll see in just a few minutes, in the first few years of my future fund, the employee and employer contributions will be 1.5% of gross pay, and the state top-up will be 0.5% of gross pay. So in this example, the total employee and employer contributions will be equal to 1.5% of the employee's gross pay of 25,000, and the state top-up will be equal to 0.5% of their gross pay. So this equates to a total annual contribution of €875 towards the employee's savings pot. All right, 1 second, that hasn't moved on. Here we go. So this is another example. So in this example, the employee is already paying into a pension scheme for job B and will therefore be exempt from my future fund for that employment. Now this means that there'll be no contributions to my future fund in respect of that employment. However, the employee's gross pay for job B will still be taken into account for the income threshold. And so they'll still be automatically enrolled for job A where there's no existing pension contributions. Contributions will be paid by the employee, employer, and state based on the gross salary of €10,000, and this equates to a total contribution of €350 a year to the employee's My Future Fund savings pot. Now, although assessing the income threshold in this way does add a layer of complexity, it means that people who work multiple part-time jobs won't lose out on the benefits. Employers also won't necessarily need to know if their employers or if their employees have another job because they won't be deciding who's eligible for My Future Fund. So as I'll explain later, NERSA will determine this, but it is something employers should be aware of. So the contribution rates will be fixed as outlined in this table, and it won't be possible to contribute more or less than these rates, at least in the initial years of the scheme. Employers will match their employees' contribution, and the state will pay a top-up instead of tax relief on the employees' contributions. Now, to help everyone adjust and get used to this extra cost, contributions will be phased in over the first decade of the scheme. They'll start at 1.5% for the employee and employer and rise by 1.5% every 3 years until 6% is reached in year 10. The phasing in of contributions will take place in the first decade of the operation of my future fund, not in the first 10 years of the employee's career. If a new employee was to join the scheme in 2033, for example, they would start paying at the 4.5% rate, and any employee who joins after 2035 will be on the 6% rate. So all contributions will be calculated on the employee's gross pay before deductions, and the employee's contribution will be taken from their net pay. So this means anything that's included in the gross pay field will be assessable for the contribution rate. Now, to help ease the cost of contributions, they'll also be calculated up to a maximum of €80,000 per annum. Contributions will be stopped by NERSA through the payroll notification for the remainder of the year after that threshold's been breached. So I'm just going to give you a brief overview of the options to opt out, suspend, or suspend contributions. And if you'd like more detail on this, there are actually videos available on our YouTube channel that go into a bit more depth. So the opt-out window will be available in months 7 and 8 after enrollment or re-enrollment, and also in months 7 and 8 after a contribution rate change. When an employee opts out, all contributions will stop, including those from the employer and the state. A full or partial refund will be available to employees based on their own contributions, but all of the employer and state contributions paid up to that point will remain invested in the employee savings pot. In addition to opt-outs, employees will also be able to suspend their contributions at any time outside of the mandatory 6-month participation period. Employer and state contributions will also be paused for the duration of this suspension. Employees won't get a refund of contributions in this scenario, however. And to ensure that the employee doesn't opt out or suspend and forget to come back, they'll be automatically re-enrolled after 2 years, provided they still meet the eligibility criteria. Employees will be able to apply to opt out or suspend through the employee portal, and NERSA will keep a track of who is due to be re-enrolled. Employers will be notified of the change through an updated payroll instruction. So just want to talk through some of the key features here. Potfall's member approach is a key feature that was designed based on learnings from other countries. It means that employees will have one savings pot in the system, even if they move jobs a lot throughout their career. It eliminates the burden of having multiple pots and the loss through fees eroding small pots. To ensure that everyone's savings go as far as they can, they'll also be invested. 3 investment management companies have been chosen through a rigorous procurement process to use their expertise to grow employee savings. The preferred bidders are Irish Life Investment Managers, Amundi, and BlackRock. The investment managers will each provide a high, medium, and low risk fund, and they'll be used to make up the 4 fund strategies available to participants. But as well as the high, medium, and low strategy, there'll also be a default strategy that everyone will be placed in to begin with. The default strategy will operate on a life cycle basis, which means that investment risk is decreased as the participant gets closer to retirement. It takes advantage of high risk growth in younger years and the stability of low risk closer to retirement. So the default strategy will allow participants to get a good retirement income without having to make complex choices or decisions. However, those that do want to choose will be able to switch to the high, medium, or low risk strategy through the portal. After all the saving and investing, employees will have built up a pot for retirement. And the retirement age for my future fund is linked to the state pension age, which is currently 66. Now, in the initial years of the scheme, retiring employees will receive a lump sum from their pot. In the future, it's likely that more retirement products will be developed and available to retiring employees. So unlike systems in other countries, employees won't be able to access their pot before the retirement age. Now, this is to ensure that savings are ring-fenced for their intended purpose, that being retirement. Now, early drawdowns will only be possible in the case of an ill health retirement. And in the unfortunate event where an employee passes away prior to retirement, their savings will be crystallized and form part of their estate. So as I mentioned before, a new body called the National Automatic Enrolment Retirement Savings Authority, or NERSA, will be set up this year to administer my future fund. NERSA will have a board, they'll be answerable to the Minister and Oireachtas, and will be supervised by the Pensions Authority. And in fact, they were established now, I think, on the 14th of October, so they're up and running. The body will bear the bulk of the administrative burden, and just to give you an idea, here are some of the main functions. So NERSA will determine an employee's eligibility for the scheme using revenue payroll data. They will then inform employers through an Auto-Enrolment Payroll Notification, or AEPN, when an employee is being enrolled, and that notification will contain the contribution percentages to be applied. NERSA will collect the employee and employer contributions from the employer, and they'll collect the state top-up separately. They'll manage the employee's savings pot, and this will include managing the administration of the opt-in, opt-out, and suspension options through the employee portal. NERSA will also manage re-enrollment and exempt employment, where an employee has started paying into another pension scheme, and they'll update the APN accordingly. They'll manage the contract with investment managers, ensuring they're complying with its terms and conditions, and NERSA will pay out the savings to employees on retirement or to their estate if they've passed away. They'll monitor compliance with legislation. So for employers, this means a couple of things, mainly paying contributions on time and not forcing employees to opt out or suspend their contributions. NERSA will also manage the public website with information on My Future Fund, as well as the employee and employer portals. Employees will be able to view their savings and execute choices, while employers will be able to check their contribution record and update payment details. The contact center will also be available to employees and employers. Sorry, I think I skipped a slide, so apologies for that. So in this infographic, it gives us an overview of how the system will work. Contributions will be collected by NERSA, who will then pool and allocate them for investment managers according to the employee's investment strategy. The investment managers will invest the contributions and generate returns, which will then be allocated to the employee's savings pot by NERSA. NERSA will pay out the value of the employee's savings to them on retirement. So I'll just explain in a wee bit more detail how this is going to work. NERSA will use payroll data from revenue to identify eligible employees. And this will be pretty quick for employees who already have an earnings record, but could take up to 13 weeks for new employees who have no earnings record. The look back is a review by NERSA of revenue payroll data to see if an employee is eligible to be auto-enrolled. For the 13-week look back period, the annual threshold will be prorated, so once someone hits €5,000 gross pay, they'll be enrolled. The 13-week look back period is on a rolling process. So even if an employee doesn't qualify initially, NERSA will continue to monitor in case they do become eligible. NERSA will send the auto-enrollment payroll notification, the AEPN, to the employer via payroll software for each employee that is enrolled. The employer or payroll operator will get latest AEPN and apply it to calculate the contributions. The employer or payroll operator will return a contribution file to NERSA, and NERSA will use this to ensure that the right amount of contributions are collected. Employee and employer contributions will be collected from the employer, and there'll be a couple of payment methods for this. The easiest and quickest way for employers to pay will be through a variable direct debit, which they can set up on the employer portal. Now, once NERSA has collected all the contributions, they'll be pooled and sent to the investment managers. So to make it clear for employers and their payroll operators what they'll have to do, I'll just go through the process from their point of view very quickly. Employers or their payroll operators will get latest AEPN through the payroll software. They'll then apply the AEPN and return the contribution file through the software no later than 6:30 p.m. on the employee's pay date. Employers will have to make sure that they pay the contributions on the same day that the employee is paid. And again, the easiest way to do this is to set up a variable direct debit through the employer portal. Now, if it's the first time an employee is being enrolled, employers will also have to notify them of this and of their enrollment date. So, because NERSA will be managing the bulk of the administration, there'll be less work for employers involved when compared to running their own occupational scheme. And this will mostly be achieved by using the payroll software that employers already have. And we're working closely with the payroll software providers to finalize the specifications applicable. And we're in the testing phase right now. So employers that don't use payroll software will be able to download the APN and upload the contribution file through their account on the employer portal. Employers won't have to worry about who should or shouldn't be in My Future Fund, as NERSA will take care of all this. But employers will have some responsibilities. Automatic enrollment is an employment right set out in legislation. There'll be a number of protections, including fines and penalties for employers who prevent their employees from opting in or who force them to opt out or suspend contributions. Any withheld or underpaid contributions will attract interest payments. So it's important that employers are aware of these obligations. Now, there are some important benefits for employers as well. The big one is that employers can ensure that their employees are looked after in retirement without having to set up or administer a company pension scheme. They can also increase their competitiveness and attractiveness as an employer in what is a very tight labour market. Also, it's important to highlight that the employer contributions will be deductible for corporation tax purposes. So there are a few things employers can do to start preparing for the launch of My Future Fund. First and foremost, they'll need to budget for the introduction of the scheme next year and in the years going forward. Now, it'll be clear to employers how many of their staff meet the age and earnings criteria, but they shouldn't forget that those earning below €20,000 a year and aged between 18 and 66 can also opt in. Employers will be asked to complete their profile on the employer portal before the system commences, and this means they'll have a direct line of communication with NERSA and they'll be able to set up a variable direct debit or select another payment method. If the employers operate a pension scheme in their business already, but not all of their employees are enrolled, it's very likely they could be enrolled in My Future Fund. This means they could have two schemes operating side by side. If there's a waiting period for the occupational scheme, employees could be enrolled in My Future Fund during this time as well. Now, if this happens and an employee subsequently wants to join the other scheme, they'll be able to do so at any time. And although there shouldn't be any major problems with My Future Fund operating as well as a existing pension scheme, employers might prefer to have all their employees in the existing scheme and should therefore start talking to their employees about that now. Now, as I've said before, payroll software will be used to enroll employees. Closer to the launch of the scheme, payroll software companies will need to update their software to facilitate this. This will help to ensure that employees can be enrolled as smoothly and seamlessly as possible, and that employers are compliant with their obligations. Under the auto-enrollment legislation, employers will need to inform their employees directly when they've been enrolled. To make this as easy as possible, we'll provide assets and advice to employers to help them fulfill this obligation. So there's a number of myths or pieces of misinformation out there about My Future Fund, and it's important that as employers and payroll operators, you have the correct information. So we're just going to go through a few of the common myths here. So much has been made about the administrative burden of My Future Fund, but the truth is the vast majority of the admin will be handled by NERSA. This includes identifying eligible employees, enrolling employees, managing opt-in, opt-out, suspension, and re-enrollment, leaving very little for employers to do. In fact, especially for businesses that don't already have a pension scheme, this will be less administration work than setting up an occupational scheme. So businesses and employers are understandably worried about an increase in costs. Contribution rates will be phased in gradually to make it easier for employers and employees to budget for the introduction of My Future Fund. And while My Future Fund does represent a modest increase in wage cost, as time goes on, the international evidence shows that contribution increases will largely be absorbed into normal pay negotiations. So My Future Fund will not replace the state pension. Instead, it will sit alongside and supplement it, like any other private or occupational pension does currently. The state pension will remain the bedrock of the Irish pension system, and My Future Fund will be completely separate to the state pension. My Future Fund contributions will be in addition to PRSI contributions. So the contributory state pension is calculated purely on PRSI contributions and doesn't take anything into account. Therefore, My Future Fund will have no effect on it. Non-contributory pension is means tested, and any My Future Fund payments will be assessable the same as they would be for any other pension scheme. Now, there have been some suggestions that the state may use My Future Fund savings for other purposes, especially if there's an economic downturn. It's important to say right now categorically that these savings are the personal property of the participants. This is laid out in legislation and provides constitutional protections, as with any private property. This means that the state nor anyone else will be able to use the savings for any other purpose. So we get a lot of questions from employers and payroll operators, and I'm sure we'll get to answer a few more in a few minutes. I just want to address some of the most common ones now. So as I explained earlier, a look-back period will be used to determine if an employee with no earnings record meets the income threshold for auto-enrolment. The look-back period will begin when the employee's earnings are reported to revenue and will continue until NERSA can establish if they're likely to meet the income threshold on a pro rata basis. Once it's been established that they will meet the income threshold, and presuming that the other eligibility criteria, they meet the other eligibility criteria, NERSA will send on an AEPN to confirm that they've been enrolled. Contributions will then commence, but they won't be backdated. From our discussions with revenue and payroll software developers, we understand that there's a large corrections process for tax. Now, this won't be the case for My Future Fund. Employers or payroll operators will have until 6:30 p.m. on the employee's pay date to make any changes to the contribution file. Once that deadline is reached, NERSA will deduct the contributions according to the latest contribution file. As the contribution rate is set at the same level for all employees, there won't be any need to correct the contribution percentage. If an employee has been under or overpaid in that period, employers can balance it in subsequent pay periods as the contribution is applied as a percentage. So the My Future Fund contributions will be rectified. Now, this might seem inflexible, but there's actually good reason for this. NERSA will be sending the collected contributions to the investment managers as soon as possible so that employees don't miss out on any potential returns. And once they've been invested, it becomes very complicated to backpedal. We will, of course, have to divest in circumstances where a refund is due, but if we were doing this all the time because of corrections, it could end up costing the employee a lot in lost returns. So the cleanest way to do this is to set a hard deadline. Now, of course, this doesn't mean that if there's incorrect information submitted, like an incorrect BPSN, that NERSA won't correct that. And we're often asked if tax agents will be able to access the employer portal on their client's behalf, and luckily the short answer is yes. Tax agents will be able to use their TAIN number to access the portal to manage My Future Fund obligations on behalf of the employer, as they do on ROS for tax purposes. Now, just before we finish up, I want to reiterate and highlight these 4 points that employers might need to consider. Later in the year, ahead of the launch of My Future Fund, we'll be asking employers to complete their profile on the employer portal and to set up a variable direct debit. This is to ensure that when the scheme launches, that there's no delay in the transfer of contributions from employers to NERSA. So by registering when the facility opens, employers can make sure that they're compliant with their auto-enrollment obligations and don't run the risk of incurring fines or penalties. Now, there won't be any standards for existing pension schemes to meet when My Future Fund is first introduced. Once there's a pension contribution from an employee or an employer through payroll, the employee won't be eligible for that scheme. However, in the future, when My Future Fund contribution rates increase, standards will be developed in conjunction with the Pensions Authority. This will be to ensure that other pension schemes are at least as favourable as My Future Fund. I suppose just to note that the power to set standards is at any time for NERSA. Now, there won't be a waiting period for enrolment in the same way that waiting periods exist in other schemes. However, there could be a period of time before an employee is enrolled so that it can be determined if they meet the €20,000 threshold. This will especially be the case for new employees with no earnings record with revenue. It's also important to remember that if an employee has multiple employments, the income from all those employments will be assessed for the income threshold. It's important to note that the earnings threshold of 20,000 is an enrollment trigger. Once an employee reaches the threshold, they're enrolled and will stay enrolled even if their income drops below €20,000 a year at any stage. So our website, gov.ie/auto-enrolment, is the primary source of information available online. And there are sections there for employees, employers, and one on frequently asked questions. We also have a latest news page where we have information on the progress of the project and any webinars that are coming up and being hosted by the department. So just lastly, referenced before, we have a playlist of videos on the department's YouTube channel. Each video is less than 3 minutes long and covers a particular topic, so you can watch all the videos one after another, or you can choose the topic you want to learn about. And lastly, if you want to get in touch with us to ask a question directly, you can do so at auto-enrolment@welfare.ie. So thanks very much. I'll pass.
Very good. Well done, Paul. And really appreciate that was a tour de force tour of all matters, auto-enrollment, My Future Fund. Now, hopefully that, and I mean, in fairness, you've imparted a huge amount of information, and hopefully that will have helped to assuage the concerns maybe that some people have, or just address some of the kind of the basic kind of fundamentals maybe that people are worried or concerned about or whatever. Can I just say to participants today, because I've been trying to keep an eye on the chat as well. So we can make the slides available afterwards. The session, colleagues in ERF are recording the session, and we can share that again. If you want to receive that, maybe just pop an email to Anna in ERF, and we'll make sure you get that. And as Paul has mentioned, if there are very particular aspects of this that you want to pop a question to the team about, they're more than welcome to consider that. We'll be producing an FAQ afterwards, as I've said, to try and sort of do a little bit of a sweep on some of the kind of the questions that are coming in. So hopefully through the combination of all of that will certainly help. What I might do over the next kind of couple of minutes as well, if I may, is just I wanted to just in reflection at a higher level, raising out of some of the detail that Paul has been in, just speak to a couple of kind of key issues that people maybe just need to be reminded about. Conscious that there's a whole variety of experience and practice out there in terms of what arrangements are in place at organizational level. And I think one of the kind of key issues is that if you haven't already done it, you need to be about this pretty quickly, but to assess, the pension gap, ultimately in your business. I mean, as is clearly the case now, anyone between 23 and 60 earning more than 20,000 and up to 80,000, etc., who's not paying into a workplace pension or benefiting from an employer contribution into a scheme will be automatically enrolled. So that whole issue of who's in, who's out, and really understanding that, and we might, in the questions even, Paul, we might come back to this thing about, people are asking about, are short-term workers covered, all sorts of categorization, and it's worth reminding there are three eligibility. Paul's emphasized this. There's the three eligibility criteria between 23 and 60, earning over 20,000. And not already paying into a work or private pension, etc. So, and beyond that, with the exception, obviously, of people who are not properly classified as workers, so to speak, then the operating assumption should be, I think, that people might be covered. But we can come back to that. The important issue of assessing the cost and financial impact of your business, really important, because there are other implications, I think, that people need to think about arising from auto-enrollment. So, for example, if you end up with, let's say a dual scheme approach where you have people who are in an occupational scheme, you have people maybe who might be covered by auto-enrollment who, for whatever reason, they're not interested maybe in an occupational scheme or haven't been enrolled in that scheme or haven't participated by the time that all of this happens from the 1st of January. Remember, in your organization, then you have different groups of workers who are in, where there's different contribution rates applicable, different administrative costs associated with that. And for those who are still contemplating what to do where they have an occupational scheme, there is still the window, albeit that window is getting shorter, where they can obviously engage with staff, engage with the employee group concerned, to see, are they interested in enrolling in the current arrangements. And probably at practical terms, that probably needs to be done probably through November, really at the latest. There are also things I think that need to be thought about in terms of the design of any existing workplace pension arrangements. So like in terms of making it easier for people either for obvious reasons to participate in the occupational scheme, where they might otherwise be attracted indeed by the auto-enrolment. And for some people, the auto-enrolment arrangements may well be a better option depending on the nature of the occupational scheme. But like, for example, I mean, a lot of occupational schemes might have waiting times for a period of time when a person takes up employment. Might be 6 months or whatever it is. And the open question is, is that something that the employer should be looking at, maybe to make it easier for the individual to join the occupational scheme rather than insisting on that waiting time condition to be observed? And again, that's something that you need to speak to your pension advisors about. I also think that what's really important, and in fairness to the department and to the government, I mean, there's been a huge effort here around awareness building. By the way, I think the communications and the PR campaign, Paul, to you and your colleagues, has been amazing. I think you can't but turn a corner, but make something somewhere about pensions auto-enrolment, which is fantastic. But I think in the organization, I think colleagues, need to understand the importance of a really good communication and engagement plan, because, people are, let's be honest, notwithstanding the job the department are doing, there will still be people who will struggle to understand, what does this mean? How does it work? What are the benefits? What should I do? Compared to maybe where there is an occupational scheme, and you need to help people to understand the benefit that they might get from the current pension rules versus what they might get from auto-enrolment. And I think this is important for each person. It is going to be different. Circumstances are going to be different, and they will want to exercise maybe their own choices in that regard. And by the way, in terms of number 5 that we have here, I just want to call this out because, we would have picked up maybe some conversations about, trying to get people into the employer-sponsored scheme. And remember one thing that's terribly important. There's been no legislative change here to oblige somebody to join an employer-sponsored scheme. And of course, there might be contractual arrangements, and those contractual arrangements might specify membership as a condition of employment. And of course, if that's the case, that's that might well be provided for. But absent of that, I think people have choices here to exercise. They need to be informed choices, and they need to understand what route is more beneficial for them. And again, to the point about auto-enrolment being effective now from the 1st of January. The legislation disapplies that sort of the normal criteria requirement that one would expect to see about employee consent from a deduction of wages. So once somebody's enrolled and they're deemed, the contributions have to happen. And I think that's important to call that out. Obviously, look, payroll providers have been awash with queries and issues about all of this. So obviously, it's important that your payroll software is up to date and can handle auto-enrolment, and in particular, obviously, the accuracy of information and records in respect of, particularly now in terms of this issue of the 13-week look-back period, and that's obviously terribly important. Paul has already called out the importance of registering for the employer portal. People are probably, and again, this is something we might talk about, Paul, in a minute. People are probably curious. I know there's been a converse or some public discourse about when that's likely to happen over the coming weeks, etc., etc. And obviously, people might be interested if there's any more insight as to when exactly that'll be live. But obviously, that's all coming at people, and that needs to be in place to facilitate the payment of contributions from January of next year. And again, back to this issue too about on the, let's call it, on broadly speaking, the in-house employment policy, staff relations piece. Remember too this point that if you're going to have people in dual arrangements, then you're going to have different staff groups on different contribution rates, maybe different benefits potentially. And while that may not be an issue on day one, look, let's be frank, in time that may well become an issue where you get one person or group of people becoming a little bit aggrieved, where they don't have access maybe potentially to higher benefits that are available to another group, et cetera, et cetera. So that could be an issue down the road for people. And again, just a reminder here, as you're working through these issues, it's important that employment contracts, especially for new hires or new joiners, are reviewed, and any policy provisions and handbooks and so on and so forth are properly updated to take account of the impact of auto-enrolment. The last thing then for me, because again, there's a lot of kind of chatter about issues to do with cost and compliance issues. And I just thought this might be a little bit helpful for people, just to get a little bit of a better sense as to what this might mean in terms of over time. And I know Paul has covered a version of some of this. And by the way, just because again, one of the questions that came up even prior to today was a question about corporation tax. I know Paul mentioned this in his presentation, but just to emphasize too that the employer contributions will be deductible for CPT purposes. So, just the example is there on the slide. So for an organization paying, CPT at that particular rate, if there's 100,000 annual contribution, then the rate, then the effective cost becomes 87.5. Now, like this obviously is now going to be the law of the land. That means there are implications for non-compliance, as one might expect. So the employer will be subject to penalties and possibly prosecution, and even potentially in extremist cases, imprisonment, etc. And there is a very direct call out and preclusion on hindering or attempting to hinder an employee from participating in this scheme, which obviously should be taken as a given, but sometimes it's important to call that out fairly directly. I think in terms of cost impacts, these are just a couple of random examples. And if if you take, for example, over year 1 to year 3, this is just somebody on 20,000. You have the employer and employee contribution of 300 each, plus the state top up. So at the end of the day, there's 700 euro going into the pot, and that obviously rises then after year 10, from year 10 to 2,800. In terms of the cost impact by business size, we won't go through all of these, but if you just take 25, where you have 25 employees on an average of about 35,000, and you take the monthly impact there for the business, so ranging from in year 1 just under 2,000 euro, 1,904, rising to 4,375. So look, I think it's just important in terms of over time to understand what are the cost implications, because we know that this is an issue of concern amidst a general sort of level of concern about rising business costs and so on, notwithstanding obviously the social good or the public policy good associated with the introduction of auto-enrolment. So what I might do is just leave that there. As I say, all the slides will be made available, as well as the FAQs afterwards. And what we might do is sort of finish off the session by picking up on a few Q&A issues. So if I might go back, Paul, if I can, to this issue of who's covered, because I'm sure, like you, we as well get all sorts of questions about, well, casual workers, seasonal workers, agency workers. Obviously, agency work is a big part of what a lot of our ERF members are part of their business. So do you want to kind of call that out as clearly as you can about who's in and who's out?
Yeah, so I suppose you're looking really at there's two cohorts, but there's one overarching thing, and that's to say that anyone in employment whose pay is reported to revenue is potentially either going to be auto-enrolled or they'll be able to opt in. Now, there's two cohorts that talking about really is the auto-enrollment cohort, which is 23 to just under 60. They'll be auto-enrolled if they're making over 20,000 euro a year across all their employments. Now, I think just to touch on that, because I think someone put it in the chat just quickly, so not to get too derailed. Employers won't need to know if someone has another employment. Nurses doing the enrolling, nurses doing the eligibility checks. You as an employer don't need to know. You'll be informed of their enrollment through an updated AEPN that'll contain, I suppose, a contribution for them or contain a percentage contribution for that employee. And then the second cohort are people that fall outside of the age and earnings threshold. So anyone between 18 under the age of 66, no matter how much they're making, they'll be allowed to opt in. The big thing that precludes people is having a pension paid through payroll for that particular employment.
Okay. And just for the benefit, I mean that categorization, let's be clear, that will also include, agency workers,
Yeah,
because at the
sorry.
end of the day, they're an employed cohort, et cetera, et cetera,
Yeah.
et cetera.
So it's contract type isn't taken into consideration. There's, I suppose, just off the top of my head, there's two PRSI classes that won't be accessible, and that's Class S and Class M. So that
Yeah.
it's really ruling out self-employed people from this and from being enrolled.
So this was actually a question I was going to ask, and just as you've touched on the PRSI classification, Paul. So directors of companies, they may be ERF members or others, directors of companies. Are they included?
If they're paying Class S, no. Now, look, I don't want to give a blanket and speak to
Yeah.
every arrangement. There could be directors that are being paid as regular employees on a Class J or a Class A or whatever.
Yeah.
But if they're Class S, no, they're not
Okay.
going to be considered.
Okay. Perfect. Um, the other issue that certainly is coming up in conversations that we're having is a bit of confusion about, and of course, in a tight labor market, people are moving around from one job to another, sometimes taking up short-term assignments of one firm or another. So when somebody moves jobs or has more than one job, now, I think you've touched on this in some of the examples you gave earlier in your presentation, but again, do you just want to call that out? And again, conscious that you've already said, look, NERS is going to be doing the assessing about eligibility and so on, but for the employer, what is it that they have to worry about where they have a cohort of people who are moving around from one job to another?
I suppose first thing is we'd say every employer when the portal opens in December, be start December, go and register because this will kind of touch on this. You might not think you've got employees that'll be eligible, but you know you can't account for every edge case, and you might end up with one. So all employers have to do make sure they're registered, complete their profile. Takes 5 to 10 minutes. We've seen some of the walkthroughs, and it's really quick and simple. And then when they apply the APN that comes in, that'll include any staff that need to that their contributions owed on. You don't need to know really anything else about that employee's employment history or if they've got other jobs. And the great thing is that that pot's following the member around, so you don't need to worry about are you paying into this pot, that pot. It's not a concern. You don't need to. And then if they leave your employment, the APN's updated as well. If there's no pay against that employee, pass through revenue, there's no contributions owed to them. So it really is a very simple process. Just make sure that contributions are paid sort of 6:30 on the pay date or
Okay.
before.
Okay. Well, that will encourage discipline anyway, if nothing else. And one of the issues that there's probably a little bit of a misnomer about or uncertainty about is how the earnings threshold might work in practice. And I suppose there's two things about that. One is what happens when you have people who are on, let's call, variable pay. They have one part of the year where they have lots of bonus earnings or whatever, and then another part of the year where they don't, or vice versa, as they may be. So more specifically, then, how will this look back period work?
So it's works on a rolling basis, looking back 13 weeks of payroll, revenue payroll data. We chose 13 weeks. It's course of the year, pretty much. And if you make €5,000 in that time, you're considered enrolled. Now, it doesn't matter whether you make money after that, if you make more money after that. So it's an aggregate of those 13 weeks. There will be times when people make more money. There'll be times when people make less money. Again, because contributions are applied as a percentage, that all balances out. You don't need to worry as an employer, how much do I need to contribute this time? How much do I not need to contribute this time? And again, uh, after they've reached €80,000 in a year, if that's the case for anyone, contributions are stopped as well.
Oh, I see.
So
Okay.
it's
And can employees, because a question I noticed that came in while we were chatting, can employees track their contributions or the contributions that are being made on their behalf through the portal?
so yeah, employees will be able to see their savings pot. They'll be able to see it growing. It'll be pretty much in real time. The investment management companies report back to NERSA, who then sort of allocate out the units notionally, and you'll basically have the value of your pot from close of business yesterday. So it's pretty much real time. For things like exact contributions records, we're looking at probably the annual statement will give a better example of that. But it'll be pretty clear, I suppose, to employees if an employer hasn't been paying over contributions by checking their pot and by checking their payslip as well, because this is something that's going to appear on
Oh, right. Okay.
payslips.
Yeah.
And just to touch on that from an employer point of view, employers can check their contribution record as well through the employer portal. So just to make sure that they've been making it, or if there's any outstanding contributions, they'll be able to see those as well.
So on the question of, because I mean, again, there was a lot of sort of before there was more known about this idea of the employer portal, and more particularly the role of NERSA. I suppose there was a lot of concern amongst employers about what was this going to mean for them? What additional work were they going to have to do to get people enrolled? I mean, from what I'm hearing, really obviously the employer needs to be registered on the portal, and uploading the appropriate information to enable registration. But after that, NERSA is I suppose leading out on the enrollment effort.
Yeah, so there's no need for employers to worry about registering employees. It's just your company details that need to be uploaded. Now, of course it's going to look different, I suppose, for different employers. Employers using payroll software, it's going to be a very automatic process for them. Similar to, I suppose, a way to look at it, maybe to allay some fears. It's very similar to the way an RPN's
All right.
applied,
Okay.
and that's done very automatically through software for a lot of people. If they're not using software, again, that's a little bit more work, but again, no different again really to how they're going to deal with their tax with revenue as well. They'll go into the portal, they'll download the AEPN, and they'll upload a contribution file.
Okay.
Um, so the APN for, I suppose, for payroll software, it contains the contribution percentages. We're in testing with the PSTA and their members right now. So they're seeing just how automatically that'll work for people as well.
But presumably, sorry, and again, I'm conscious picking up on points that are coming in on the chat. But I mean, the employer has to register, is like the pay. You may have a payroll provider who are helping you and so on, but it's the employer who needs to be registered.
I suppose the employer or the agent, the tax agent. So again,
Okay.
similar to how you deal with your how you'd interact with RALs. If you have a tax agent that deals with RALs for you, say
Okay.
you outsource your payroll, then yeah, they'll be able to register on your behalf using TIAN. The one point to note is that when you're setting up your payment details and you're setting up your direct debit, just make sure that you're authorized to set up that direct debit. That's probably an important thing to remember as well.
Sure. Okay.
Can I just add something to that, Brendan?
Yes, Lisa.
It might be useful. We had an event a couple of weeks ago where we did a portal demo. So it's like a mock-up one. It's not the final, but it would be clear to people then and they can see how it's going to work. But we're going to publish that in the next couple of days on our hub. So it might be useful for people to have a look at it because
Oh,
it'd be
great.
easier if you actually see it, rather than listening to
Absolutely.
people
Well,
talking about it. Yeah.
again, it would be great. I mean, if there's a link to that or whether that we can
Yeah.
get shared
Yeah.
out. I mean, maybe
Yeah,
after
we're at the
today, that'd be
final edit
fantastic.
at the minute. So yeah, we will
Okay.
publish that and we'll send it out yourself and you can send
Yeah.
it out to your members. Yeah.
And can I just ask, I mean, without holding you to an exact date, but what roughly speak, when are you hoping to see this portal live?
The first week of December.
First week
Yeah.
of December.
Yeah.
Excellent. Okay.
Yeah.
Well, thank you for that.
And there'll be a campaign, an advertisement campaign for employers to let them know when the date launch is, so they can access the portal then and have a look at all their details and what they have to do. They have to complete their profile, set up their payment method, and inform their employees because their names will be on lists basically.
Okay. Okay. Appreciate that.
Yeah.
And one other issue, I think you did address it, Paul, but just to call it out, because I see it came up in a question or two, is when we talk about earnings and so on, we're talking, I mean, everything's in the bag here, right? It's not just, because this is important, I think, because in the occupational pension world, as you know, a lot of contributions are calculated sometimes on base pay, maybe only, or pay is very specifically defined for occupational pension purposes. For auto-enrollment purposes, when you talk about the criteria, etc., the eligibility criteria, the earnings, it's all earnings.
It's everything that goes into the gross pay field
Yes.
sent to revenue.
Okay.
So yeah, that could include benefit in kind. It could include
So
shares.
that's bonus, it's shift, it's
Yeah.
overtime, it's whatever it is. Yeah. Okay. All right. That obviously that's a hugely important point. Now, I noticed at the very end, you were sort of calling out the 3 or 4 big ticket things for employers to do, right? And I'm just conscious of our time, but in the last kind of couple of minutes that are available to us, as you've traveled the journey here, because you guys have kind of been up close and personal trying to figure this thing out and make it work, what would you say for ease of getting into this for the employer? What are the couple of things that they need to get right in the coming weeks?
So I suppose firstly, it's budget. It's look at your budgets to make sure that there's money put aside for this. It's coming the 1st of January. It's going to happen, and whatever that means for your particular company, that's what you need to do. It's first and foremost, and then there's sort of 3 steps, and this is going to ring true with the communications campaign as well, and that's register, complete your profile. Sorry, on the portal come December. Set up a payment method for contributions, and then you're looking at running payroll. To ensure that the APN's applied. That's really the big ones. After that, there's one more thing, and that'll be to inform your staff that they've been enrolled, but we're making that, I suppose, as easy and simple as possible. What'll happen is when you get your APN that has the sort of contribution percentages to be applied, employers will get into their secure mailbox on the portal letters, enrollment letters for employees. You can download these. You can then email them out. You can print them off, hand them to employees. But it'll have the enrollment date on them and all the information that you'll need to provide to them, sort of to stay compliant with the legislation. But it's as simple as going into that secure mailbox on the portal, getting
Okay.
those and giving them out.
And just to add to that as well, that the employee portal will be available from January. It's the employer that's available from December. So they'll have heads up that they can communicate to their employees that they've been
Okay.
enrolled. Yeah.
Okay.
After from January, obviously the employee can go in themselves and
Yes,
see
understand.
their pot. Yeah.
Okay. All right. Look, fantastic, guys. Really conscious of time. By the way, just one last thing for me, just to call out, because this is something that kind of I've spent a bit of time on as well, trying to understand, obviously, for my own purposes and for colleagues and so on. One thing that I've noticed too, that the Society of Actuaries has recently kind of called out a little bit, and I think it is important just to say, is that there's a little bit of a misnomer out there that would suggest, people say, oh, well, look, auto-enrollment would be attractive for lower earners, etc., and for higher earners because of the tax relief, that the only way to go is, occupational schemes. That's a gross generalization. It's very important that people make their own assessments as to what is right for them, because we understand pensions is complex and so on and so forth, but this is so important for people to get right, to take advice, to be informed, and certainly speaking to any employers who are on today's session, just make sure that people are able to get access to the right information so that people can compare and contrast what the benefits are of both, whatever it is that's in place in the employment in terms of occupational arrangements, that they can work out the true cost for them of the contributions, allowing for the fact that on the auto-enrolment there's the employer contribution as well as the state top-up, the tax relief obviously then in the occupational schemes, and that they can make an informed choice. But do not make the assumption that one is better than the other automatically, because that is not the case across the board. And just take advice. We might leave it there, guys, if that's okay. That's been really fantastic, and thank you for getting through such a volume of material. I'm so conscious too, by the way, for colleagues who've been posing questions, as other stuff has come in as we've been chatting. We will try to cover as much of this as possible in the FAQs. But look, the fact that people are asking questions shows to me they're hugely engaged. They want to get this right, and they will, for the most part, I would like to think. And look, let's hope that journey continues, and this is a successful launch from the 1st of January. But can I just say, Paul, Lisa, and Anthony, thank you guys for joining us this afternoon. Particular thanks to the amazing Anna Douglas and ERF, and to Jer for pulling this together. It's been really informative for me, never mind the participants. And look, thank you very much for your time this afternoon.
Thanks very much for having us.
Not at all. Thanks, guys.
Bye. Thanks.
Bye-bye.